Hollywood writers are in their third day at the negotiating table as the actors' strike hits the 2-month mark. The UAW partially expanding its strike today as labor disputes hit industries from autos to healthcare. There could be even more walkouts as contracts expired last week for more than 50,000 Las Vegas culinary workers, while those 75,000 Kaiser Permanente healthcare workers authorized a strike if this week's bargaining sessions don't end in a deal. What's it all mean for some big names in these sectors? We're going to take a look in our strike edition of 3 Buys into Bail today. Joining me now is Gina Sanchez, Alito Advisors Chief Market Strategist. Gina, it's good to see you again. Welcome. Your first buy is Stellantis, the Chrysler parent, Chrysler Fiat, whatever, Jeep. We'll just call it the Jeep parent company. Their shares are up nearly 4% since the UAW strike began a week ago. Bernstein says they've got more inventory that's well positioned to weather the strike, but they've also warned about an increase in labor costs, shaving about €1 off of full-year EPS. And they announced new layoffs along with GM yesterday. Why are you bullish here?
So I'm bullish because if you look at the value for the margin, because at the end of the day, when you're talking about labor strikes, you're talking about increasing wages, healthcare benefits. That's really what's on the table here. So you want to see how much margin each company has. The biggest margin and the biggest winner, obviously, here is Tesla. But Stellantis actually has a very solid margin compared to both Ford and GM. They don't have a ton of debt. So they can weather this storm better. And their brand value is still off the charts. I mean, they still own Alfa Romeo. They own Maserati, they own Jeep, they own Dodge. I mean, these are big, big brands. And so I think, the point about inventory is important when you're talking about a strike. You're talking about people, walking out. But this is a company that is also really, really well valued compared to a Tesla with great margins. And so value for margin, this is the bet.
All right, up 36% already this year. Ford up 13%, GM down 3%. We'll move on to Hollywood. Disney, the writer's strike approaching its 150th day, and negotiations with those major studios are entering their third. Bob Iger, one of the executives at the bargaining table. But even if a compromise is reached, there's concerns. So let's talk about the second buy of yours, which is Disney. There's concerns about their linear TV business after the charter blackout and rumors of the ABC sale. Little concerns about how much they're investing in parks. Gina, why would you like the stock here?
Well, so I think one of the things that everybody's kind of questioning is, who has content, who has enough inventory to weather the, the continuation of this strike, and who's going to bounce back after. Most people are focused on Netflix because they have the biggest margins, but Disney also has strong margins. And if you look at their investment into parks still remain one of the strongest revenue sources. They cannot raise prices enough yet to really even limit park demand, which is impressive. And content-wise, at the end of the day, all of this is about content. Content is king, and Disney owns content. And so, this is one that you're going to have to play for the longer term. This is one that we own. We own both Disney and Netflix. We're playing both sides of this. But we think that Disney is extremely well priced. And obviously, the Chapek-Iger whiplash did not help. The mess at Spectrum on a big game weekend did not help. All of these things are missteps, but we know that this is a company with strong brand value, and that's going to come through over time.
All right, quick on our last two. We'll start with your last buy, which is in the healthcare space. It's not Kaiser, where we could see a strike, but it is another healthcare name or hospital even. Which one?
It's HCA. So we actually own HCA in our portfolio. And, HCA is one of these that has, again, a strong enough margin, that are around 11%. Actually, HCA is probably up a little higher than that in terms of margin. But they're also well priced. And most of these healthcare companies, particularly HCA, Tenet, are both making big investments into technology in order to help push costs down. And so I think, the issue with healthcare is that the demand is unlimited, and so you have to figure out how to provide that demand with workers that you need. So right now, workers are the limiting factor. So figuring that out is important. And if you look at sort of the healthcare systems broadly, which most of them are actually nonprofits, they're actually having a really hard time. Many small community hospitals are at the brink of bankruptcy.
Right.
So, these big systems have a huge benefit because they can invest in technology.
All right, then that brings us, drumroll please, to your sell, or the one you're bailing on, which is Wynn Resorts. They, along with MGM and Caesars, face that potential culinary worker strike. The vote comes next week. Why does this one jump out to you to the downside real quickly?
So this one's tough. Look, this is a bad. This sector was really hit in the pandemic. They have not recovered. Unlike the auto sector that has largely recovered from 2008, this strike is really going to hit them when they're down. The outlook for even the best of these companies, which is Caesars in our opinion, it still isn't even that great. And, you look at Wynn and their outlook is terrible. And so this is just, I think that this strike is going to hit them when they're down, and it's going to make a bad situation worse.
All right. Well, you brought us, I love when you bring us full circle here. We got back to Caesars. That was a stock pick from our small cap stock picker earlier this hour. Gina, we'll leave it there. Thank you very much. Gina Sanchez with Lido Advisors.